Well, it's 2017 and it's time to think about funding your Roth IRA portfolio. Hello and welcome to another episode of the VMC Inc. Financial News Network. I'm Victor Campos. You'll want to set up some tax-sheltered retirement account, and a Roth IRA is a very good choice. Watch our previous videos where we discuss why. I'm going to mention a variety of Vanguard ETFs that we'll use to fund our portfolio. Feel free to use your own favorite brokerage, of course. We recommend Vanguard because it's such a great consumer-focused company with very low fees. Fees are what often eat up your performance. I'm going to mention 5 ETFs that could form the basis of a really powerful portfolio in 2017. First is VTI, the Vanguard Total Stock Market ETF. This ETF seeks to track the performance of the CRSP US Total Stock Market. So this is a variety of domestic stock in the large blend category. This has an extremely affordable 0.05% expense ratio. It's 95% lower than the competition. Now, the risk versus reward potential is high. High risk, but high reward. And that is evident in these returns. A 1-year has yielded about 12.68%, 10-year is at 7.23%, and since inception, 2001, 6.32% return. $10,000 in about 10 years has grown to over $20,000. The second ETF is the Vanguard Dividend Appreciation ETF, VIG. This seeks to track the performance of the NASDAQ US Dividend Achievers Select Index. It's also domestic stock and large blend, with a higher expense ratio of 0.9%. Same sort of risk versus reward, and very good returns in the long term as well. Since inception, 2006, 7.34%. Again, $10,000 doubles in about 10 years. Next is the Vanguard High Dividend Yield ETF, VYM. This also tracks companies that focus on dividends, as opposed to VIG. This one focuses on above average dividend yields. So it's a little bit more focused. It's a little more targeted. It also has a 0.9 expense ratio, 4-level risk and 4-level reward. Since inception, about 7.42% return, and $10,000 doubles in 10 years. Next up, we've got the Vanguard Extended Duration Treasury ETF, or EDV. This portfolio will mostly have stocks, but we're also going to use bonds for some steady income. This fund seeks to track the performance of the Bloomberg Barclays US Treasury STRIPS 20 to 30-year Equal Par Bond Index. This has a lower expense ratio of 0.7%. It's based on long-term government bonds, U.S. government bonds. That's very risky, but a lot of reward. Here we're seeing perhaps 3 years is the sweet spot, as well as 10 years. Now this fund is about to turn 10 years old in 2017, and we're getting perhaps on track compared to the benchmark around 8.26% return. We're seeing here that this one's a bit more volatile than the previous funds, but we're seeing the return has touched $24,000 in less than 10 years. It is trending upward in general, although we've lost a little bit of that investment, still nearly $20,000 in less than 10 years. And lastly, we've got the Vanguard Rate ETF, Real Estate Investment Trusts, VNQ. This is sector specific, so this is focusing on real estate. This does have the highest expense ratio in our portfolio of 0.12%. It's still 90% lower than the average expense ratio of funds with similar holdings. It's at 4.4 again, and we're seeing here, even on a 1-year investment, we get about 8.53% return. 10 years is 5.23, and since inception of 2004, we've got 9.21% return. This one hasn't quite reached the $20,000 return in 10 years, but it's still on an upward trend. And with a return of 9.21% since inception, this could yield a lot of return. So the way we'll set up our portfolio is we're going to invest a maximum contribution of $5,500 for the year 2017 at these amount of shares based on these prices. These were the prices on the first trading day of 2017. So we've got 10 shares of EDV, 13 of VIG, 14 of VNQ, 9 of VTI, and 14 of VYM. We see the various prices here on that close of the first day of the 2017 trading day. And it's only been a week, but we see we've made $56.35 on that investment since purchase, or about 1.03%. So we will track this portfolio, which is about 20% bonds, 20% real estate, and the rest in stocks, focused also on dividend stocks. We'll see how our portfolio does throughout the year in 2017. And the takeaway here is, no matter what you invest in, you want to invest in the long term. One day, you could have downs. 1 week, you could have ups. But based on your time horizon, the longer it is, the more likely you'll have great returns. So if you haven't invested yet, now's a good time to start. Think about a Roth IRA or a traditional IRA. If you don't have a 401k or such retirement vehicle, you have a maximum contribution of $5,500, up to $6,500 if you're retired. So we'll see how our portfolio does. Do you have opinions on some good ETFs? Share a comment below. This has been Victor Campos for the VM Sync Financial News Network. See you next time.